In 2026, the term AI is printed on almost every piece of financial software. It has become a marketing phrase designed to sell subscriptions. Buying a tool based on a sales page usually means wasting money on hype, while the actual bottlenecks keeping you from managing your money effectively remain completely unsolved. We evaluate 3 domains: personal budgeting, investing and trading, and enterprise finance. Watch the tech buzzwords sort into these circles. Across all 3, you face a central trade-off: yielding data access for software control. A chat coach requires a different architecture than a trading agent. Success in 2026 requires deliberately matching the specific architecture of a tool to the exact way you interact with your money. For the everyday consumer, modern budgeting apps force a difficult choice between automated data collection and personal privacy. The first major bottleneck for most people is that a passive tracking dashboard doesn't actually help change spending habits. They need active financial advice. Conversational LLM tools like Waypoint solve this by providing context-aware coaching based on your real numbers, but they require you to actively chat with them to get value. This decision tree maps out the second major bottleneck: the sheer friction of manual transaction categorization. It branches left for those who need advice, and it branches right for those who simply hate manual entry. If you take that right path, predictive machine learning tools like Copilot or Monarch step in to automatically categorize your spending with near-perfect accuracy. The trade-off for that predictive accuracy is that these tools cost roughly $100 a year, and they require you to hand over your bank credentials to third-party aggregators. We can branch this tree to a third option: AI input tools like Finny. These ensure total privacy by bypassing bank links entirely, opting instead for you to upload manual receipt photos or voice notes. The best personal finance AI for you is whichever one removes your specific behavioral blocker without crossing your boundaries on privacy. Shift focus to the active market participant and the trade-off changes. Here, you are yielding your autonomy for trade execution in order to maintain safety. To understand what modern AI looks like, we have to look at the rigid, legacy trading bots that dominated the market a few years ago. Those traditional bots execute blindly based on fixed rules. When a sudden change in market conditions occurs, they fail because they cannot adapt. This quadrant chart maps the modern alternatives. In the top left quadrant, we have data-dense AI scoring models like Danelfin, which process thousands of daily technical and fundamental indicators. These scoring tools provide probability-weighted stock selections. They give you the signal, but you still have to manage the timing and physically execute the trade yourself. Down in the bottom right quadrant, we plot full execution agentic trading systems like Horizon.Trade or Trade Ideas. An agentic system operates on multi-step goals. It monitors the market, adapts to ambiguity on the fly, and adjusts its approach based on changing conditions. The danger here is that these systems can hallucinate. They require mandatory human oversight checkpoints, so you can step in before an algorithmic error drains your account. Traders in 2026 operate as risk managers, supervising the automated execution of complex multi-step goals rather than manually entering every position. Inside the enterprise finance team, the tension lies between enforcing strict corporate governance and the relentless demand for operational speed. The foundational bottleneck for CFOs right now is attempting to deploy AI directly on top of messy, unconsolidated ERP data. This workflow flowchart illustrates the danger. Applying AI to bad data just surfaces symptoms and processes errors at lightning speed without fixing the root cause. The proper solution for clean data starts with AI close tools like Numeric or Blackline, which automate the heavy lifting of account reconciliation first. These systems automate high-volume matching tasks to compress the month-end financial close from an industry average of 6 days to under 2 days. Once the ledger is clean, AI accounts payable and receivable tools like Vic.ai or Ramp step in to enforce spending policies and eliminate manual invoice entry. The human cost of this automation is real. It is rapidly displacing lower-level data entry jobs within the accounting department. CFOs who ignore these automation tools are forced to dedicate their most expensive talent to manual data entry, while competitors reallocate those same hours to strategic analysis. Pulling back to view budgeting, trading, and enterprise finance collectively, a clear pattern emerges across the 2026 landscape. Finance teams using these tools report 70% less manual data processing and 95% better accuracy. By compressing a 6-day close cycle into less than 48 hours, the volume of repetitive pattern recognition work drops significantly. Professional focus moves to the escalation points that actually matter, the edge cases and strategic decisions where human oversight provides the final layer of safety. This summary scorecard maps recommendations by need. For budgeting without spreadsheets, choose Waypoint or Copilot. Active traders transition to scoring tools like Danelfin or Trade Ideas. Enterprise teams adopt platforms like Numeric or Blackline to end manual reconciliation. Do not buy a subscription simply for the sake of using AI. Identify your exact bottleneck, pick the architecture that matches it, and protect your downside.